the ways I look at gaps is to look at the one-day vols. If one-day vols are very cheap, you might think that that's justifying the gap. Well, actually, what it does justify is it justifies me taking defensive puts. If one-day vol is very, very cheap, then I can protect my downside from people closing that gap very easily. And because I can protect the closing of the gap very easily, I do. What does that mean? Gamma builds. What does that mean? Sellers come in as soon as the gap starts closing, and we get the closing of the gap. It's almost a self-fulfilling prophecy on gap fill. You hear a lot of professional traders talk about gap fill trades. One-day vols is one of the best ways to recognize whether the gap will fill. So when I look at one-day vols, and I get a day like this where we've got a massive gap, I want to know if one-day vols are very, very cheap to buy a put option with. You can see one-day vols were so cheap, it was almost embarrassing if I didn't buy a put option with those very, very discounted one-day vols. So in other words, I believe this is going to create a gap fill. Because I buy a put option at that point, it creates a gamma downside. And therefore, whilst it might not necessarily sell off, when it starts to sell off, especially when you see wholesale strikes like 523, 524, you know that these are going to be price levels that gamma is going to become very obvious. So when it hits 124 and rejects here, I know it's almost a given that gap fill is going to take place. You can see here that we had a gap open higher. And again, you can see that we get a one-day vol very, very cheap. So I am going to use that cheapness to protect my sell side portfolio. And therefore, we get that trade on. We get the opportunity to close the gap. We absolutely close the gap with a very strong gamma drive to the downside. And we make the monies. Well, this is interesting because you might not see this as a gap open on Monday, but it was a gap open because the closing price was here. So if that was a closing price, then you can obviously now recognize with me that that closing price there, the price opened up here, that's a gap open higher. So with that gap opening higher, I can now recognize that it's very cheap again. I can protect by buying put options with that cheap option. I am going to buy a put option into that top line, preferably a wholesale strike like 524. And there's my cover. A beautiful, not only a gap fill, but a significant gamma slide on yesterday's business. An incredibly easy way to make money just by recognizing this little part of the process. It's really not difficult. The cheapness is associated with a gap down. Well, that's going to be more inclined to then bring call buyers into the market, isn't it? Remember, this is cheapness and expensiveness, not supply and demand. So that gap down there, they're also pricing very cheap and against the previous day. So they're expecting a buy-side bounce. So we can look at that cheapness and we can recognize what they're likely to do with it. When you get one-day vols that are very, very expensive, for example, at top edges, why are one-day volatilities incredibly expensive at the top edge? Because the demand's driven them up into that top edge. So there's a very good chance coming into the closing bell that that's going to peel away. And all the demand that's been in there is going to dry up into a sell, which is exactly what happens. One-day vols, if you can understand it, and it's a class in its own right, one-day vols can be incredibly knowledgeable information for you to put into your portfolio, but it's not for 1 minute charts. It doesn't really have a lot of information on the 1 minute charts, but it is for those macro views. Looking at it on an hourly 15-minute chart has a lot more reason to be real than looking at it on a 1 minute chart. The other challenge we had at the top edge from yesterday was the fact that the volatility surface was very bearish. Take a look at the volatility surface and you'll see exactly what I mean. You can see the volatility surface didn't support this sell trade. It supported this sell trade, but it didn't support this sell trade. But it definitely supports this sell trade. So again, you might say, well, if the volatility surface doesn't support my trade, then I'm not going to take the trade. Absolutely fine. If that's what you want to do, that's what you want to do. Crack on, McDuff. The point is that it's definitely something you should also be paying attention to. Because when you see something starting to turn around, you know that there's gamma below here because of the cheapness and because of the gap open up. So when it turns around, you want to hit this one. So you could have hit this one in this candle here. You can see that the volatility surface had went softer here, and then we got an up candle here. So if you wanted to hit with the volatility, that would have been your sell trade there to take advantage of that gamma sell. Cheap options brings activity, hedge activity. We saw that actually from the tail ETF, didn't we? Remember we looked at the tail ETF and it told us what they did? Anybody remember? It was the Cambria tail ETF. And when you look at the tail risk, we remember what they talk about. We remember what their conversation is regarding this. And here's a conversation here. The Cambria tail risk ETF seeks to mitigate downside market risk by purchasing a portfolio of out-of-the-money put options on the S&P 500. On the S&P 500, put options, as well as US Treasuries, right? You may say, but why has this got anything to do with the gap? Why is this of any importance to me? Take a look. Why tail? Laddered put options on the S&P 500 to offer a potential hedge against market exposure. Laddered put options. Okay, so they're laddering in buying of put options. But take a look at the next comment. The potential advantage of buying additional put options when volatility is low and very few put options when volatility is high. So when do they buy put options? When would you imagine this fund buys put options? Well, it tells you. When volatility is low. When volatility is low, when put options are cheap, when do put options become cheap? Bottom edge of market or top edge of market? Bottom edge or top edge? When do put options become cheap? Top edge. When do they become very cheap? Gap top edges, correct? So put options become very cheap on gap open top edges. So we can now recognize that this is a fund. This is their own web page. It's the Cambria Tail Risk ETF. This is their whole entire business plan. So it's not me telling you this. It's a mitigate downside market risk tracker fund. So they're telling you that when volatility is really cheap, they'll buy options. They'll buy put options in the S&P. So they'll buy put options when it's very, very cheap, and we look at it and we say, well, it's a lot cheaper at the start here, but it's a gap down, so that's not the right trade. But it's very cheap here with this gap up. This is a brilliant trade. Now, it doesn't mean it's bearish. That's not what Cambria are talking about. They're not talking about that this is bearish. Oh no, all they're saying is that they are putting together a downside risk mitigation opportunity for you, and therefore they buy these options out of the money when it's very cheap. Well, this is just taking that one step further into the very short term. It's going to be very cheap here. It's going to be very cheap here. It's going to be very cheap here. Now, we don't see any of these ones as cheap, so I'm not looking at this as a very cheap one-day coverage. And I'm only interested in 1 day because that's the attention span that we've got on these short-term trades, is that 24 hours. So when I look at cheap, this is incredibly easy to spot, isn't it? If I look in the background, here was another day. Here, look how cheap this is. There's a gap open up. And as the gap open up comes to a top line, again, it's not bearish until a top line's in, until we do some business. And then as soon as it starts to sell off here, I know there's going to be a bit of a splash on this one. Absolutely know there's going to be a bit of a splash. It's very cheap to cover that top line. So therefore, when the top line jams, and sometimes, guess what happens? How do you cover the top line as a hedge fund? How do you cover the cost of that top line? You sell calls and it becomes sticky. How do you cover the cost of that top line? You sell calls and it becomes sticky. How do you cover the cost of that top line for those put options? You sell calls and it becomes sticky. How do you cover the cost of that top line? You sell calls and it becomes sticky. And you can see that this short sell, this short sell, this short sell, and this short sell were all identical. Second thing that's similar in all of those short sells is they all made significant monies. And we love the monies. Everybody loves the monies. We certainly love the monies. Sell side on Monday, sell side only. If you were following this process, this is not new information. We've covered this in class.